What is a stock purchase agreement, and how is it used as part of the venture funding process? Well, a stock purchase agreement, as the name implies, is an agreement between the company and an investor, whereby the investor is agreeing to purchase an ownership interest in the company in exchange for certain value, usually money. Now, the ownership interest that the investor is purchasing is generally in the form of shares of stock, and that may be a common stock or a preferred stock with specific rights. But this is the agreement that memorializes the obligation of the company to sell that stock and the investor to buy that stock at a given rate. It is a contract. Like any other contract, it begins with the preamble. It simply states who the parties are and where they are located, things like that. These are not enforceable provisions. These are identification provisions. After that, you'll sometimes have recitals, which is, again, the scenario or context in which this agreement is taking place. Many stock purchase agreements do not contain recitals, so I don't list them here. But if you do see something that states whereas blah, 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 these also are not enforceable provisions. These are simply contextual markers or indicators for what is going on and the reason for this agreement. After that, you have the action statement, and this is where the parties specifically agree to exchange value. That is, the company will provide this number of shares of stock in exchange for this dollar value. It will typically state the dollar value and the number of shares and the value of per share and the total value added together. Okay. Then you have the provision that is the rights of the parties. The rights of the parties are generally the provisions stated in the term sheet that have previously been negotiated. They are just further expounded in this agreement. Oftentimes they make reference specifically to the bylaws that will be amended and restated as part of the agreement, but it lays out things like redemption rights, rights of first refusal, liquidation preferences, conversion rights, piggybacking rights, registration rights, many of the provisions that are negotiated as part of the funding deal. Okay. After that, you have representations and warranties. These are the things that each party tells the other side is true, such as the company says they are organized in this location, that the board of directors has approved and the shareholders have subsequently approved this transaction, that so-and-so actions have been taken in furtherance. These are representations and warranties. Okay, you're saying something is true and you're warranting that it will be true at the time of closing or consummation of the transaction. On the other side, the investors state representations and warranties as well, that they are an acquiring entity owned in this way, that their intentions are so and so, so and so, so and so. So it states out everything that one party represents to the other that's material to the negotiation. Covenants are secondary obligations of each party that each party has to do in order to bring about this transaction. On the part of the company must follow through with all the governance procedures to make certain that the articles are amended, the bylaws are adopted, and other directives are effectuated pursuant to corporate governance procedures. So these obligations are covenants that the company will undertake this. If the investors are assembling money, say it's an angel group or a venture capital fund, they may make representations about calling down funds from investors and readying the funds on given milestones, things of that nature. So things that need to be done in order to effectuate the action statement in the agreement. Conditions are things that must be true in order for the agreement to be enforceable. Or if these conditions occur, it makes the agreement as it stands unenforceable. These are conditions precedent and subsequent. So what happens here is, if you need, for example, the venture capital firm to be able to call down capital from investors in order to fund the business, well, if this is contingent in any way. If it is possible that the venture capital fund will not be able to collect the investment funds from their limited partners that are putting money into the fund, well, this is a condition upon which funding the startup venture or purchasing an interest in the startup venture is contingent. So if this doesn't materialize, then the agreement dissolves, for example. There can be any number of conditions, but just think about it in terms of anything that is stated that must be true before this agreement is enforceable, or if this happens during the term of the agreement before the closing date, then the agreement is no longer enforceable. Okay? And then in-grain provisions. What happens if one of the conditions occurs and the agreement is unenforceable? Or what happens if one party breaches any representations and warranties by stating falsehoods, or one party doesn't live up to the covenants that they promise, or during the meantime they don't take steps towards completion of the obligated actions in the action statement? If any of this happens and the agreement fails, what is the result? These are known as in-game provisions. What happens if one party defaults or does not live up to or adhere to their obligations under the agreement? Now, this is a general structure for almost every contract, and the same applies for a stock purchase agreement. So when you're reading a stock purchase agreement, look to identify the portions that are organized like this structure of the agreement. And it will help you understand everything that's present, and you'll be able to read it more effectively when digesting the various terms in the agreement.